All right, Chad, we're breaking out the cash for the thumbnail, so that means we're going to talk about something good. And this time, it's not the banking crisis. I want to talk about the recession. So a lot happened today. It was a pretty wild day. It was actually our biggest down day in the last month. However, the market's going to be focused on earnings next week. We get the big tech. Then next week after that, we're going to be getting Powell. But there was a very important data set that happened today or came out today. And it is now another one of the recession checkboxes. So I want to go over that with you. We're going to talk a little bit about what to expect. I know you've heard the words recession a lot. And my thing about it, I made this video about a year ago, just under a year ago. It was the first time when the yield curve inverted. And I said, I can't believe it's happening. But even in that video, I said, watch 12 to 18 months. And we're about 3 months or 1 quarter now away from reaching that 12-month box. And now in the process too, we've been noticing some stuff with the economic data. So really what I want to talk about, the Philly Fed, and then 2, good news being good news and bad news being bad news, especially as it pertains to the job market. And then finally, I'm going to go over all the biotech plays with you. So got a nice little setup. I hope you're ready for a nice little chat. Honestly, I'm wearing the most awkward outfit for this. I was wearing my pajama outfit my mom got me, and then I just said I'll throw on a watch to confuse you. It was getting weird, but I'm comfortable, so I hope you're comfortable. And I hope, as always, even from a year ago, please don't let recession talks ever scare you. I mean, again, you could see what I'm trading and what I'm holding. I do want to make sure that everybody is educated, but I am not in the business of selling fear porn. And I hope that the information that we present, I hope that it gets you more prepared, it gets you more fascinated with the topic, and has you more prepared so you could handle your finances the right way. But this isn't, go buy gold, run away, all that. I do got gold though. I'll get the gold in the next thumbnail for you. But let's talk about the Philly Fed. So this came out today, and it came in at negative 31. The estimate was like negative 15 or negative 19. So it was already expected to come in bad. But why it's so key that it came in below negative 30? Well, take a look at the multi-year chart of it. This is going back to the 70s. It has only dropped below negative 30 a handful of times. Just take a look at the history of this index as we see at the far, wherever we started today. This one came in negative 31. The only other time we dropped below negative 30, it was in 2020. Go back a little further, you'll see right before 2009 and 2008, we also had the drop. Then you have another one in 2001. And that's, again, all of these, you see the Philly Fed below 30. Then in 2001, that was another one. Then the beginning of the 80s, that's after Volcker. You got a little bit of volatility. We saw the markets drop around there. And then even at the beginning of the 70s, when inflation started, and that actually looks a lot like where we're at now, you also saw the Philly Fed below 30. So why this is important now to our discussion, because last year, as everybody was bringing up recession, and they're like, again, especially in October, that was a big one when things were getting really bad. The market was low. The data was crumbling. A lot of people in October, they were saying recession. And I even put this at the beginning of a watch list. I remember bringing it up, and I said, ironically enough, though, the Philly Fed is not below 30. Pretty much, you have not had a recession without the Philadelphia Manufacturing Index showing a print of negative 30 or larger, because it's only happened a few times. So somebody asked about this today. They're saying, well, now that it came in at negative 30, does this mean that we're going to enter in a recession? No, but every recession has had a negative 30 print. So does this mean it's going to happen? No, it doesn't. And this is why, the timing of everything, that's the big thing I've been focusing on lately. We don't know the timing, and I don't think anybody does. I got a window for the summer, but then we even got 6 months after that. So we'll see what happens. But overall, this is now just one of those check boxes where you could say, okay, check, now we have it. So if things did develop that way and things really did start to get negative, at least now compare this to October or any other point last year when the fear was hitting the peak. You didn't have economic, hard or soft economic data. None of it was hitting like this. So I thought this was a big deal today. I don't think the market reacted. If anything, they probably took it as face value. Again, expectations -15, coming in -30. It feeds into the theme of contractionary economic data, and we've seen how people freaked out. So coming to my next point now, even part of with what you saw today, you had initial jobless claims, and that came in a little hotter than expected. But if you've been following along with the market, the recession talks this whole last year and a half or so, I'm sure you're aware the Fed wants to see higher unemployment. We don't want people to lose their jobs, but we want to see higher employment. That's what they say. You've heard this a lot. And why that's so important is simple. If the job market is hotter, it is going to lead to more inflation. If people have a lot of jobs, they get jobs easy, they make a lot of money, they're going to keep spending more, demand keeps going up, supply limits a lot of items and commodities, inflation goes skyrocketing. That has been the scenario or narrative you have been following for longer than a year now. And that's why at some other points throughout the year, when jobs data would come in good and you'd be like, wow, Joe Biden, yeah, we did the best jobs in a long time. I brought employment down. And it seemed like really good news. Again, why wouldn't you want to see people with jobs? The market would sell off because the better jobs were, it meant the longer the Fed was going to hold rates for, the more they were going to raise them. It was overall negative and meant more inflation. So here's something, and this is why I'm bringing it in context of this recession video, because one, we got the Philly Fed today, but we kind of noticed this a couple of weeks ago where good news was actually good news and bad news was actually bad news. So I hope this video helps you, because we're going to watch throughout the future here this year. At one point, bad news will be bad news for jobs and good news will be good news. Maybe even good will be bad, but here's my general idea, and what I'm trying to explain to you right now is in context of the recession, we may start seeing people react to job losses negatively, because right when we start seeing job losses show up on the unemployment data and the non-farms, that is the final shoe to drop of recession. That's what Powell's been saying. That's what everybody said for a while, even in 2008, before real estate went down, before any of that, you had job losses. But here's the thing. We all know the data's lagging. We all know it's late and behind, but we still have to react to what we get. So in Wall Street's view, there will be a point this year, or as we develop this recession argument, we will watch jobs come in bad and the market will react bad, because at that point, if Wall Street says, oh man, jobs are bad, that means the tightening effects, the slow economy, it's even showing up on lagging data, and now we're actually seeing it. That is the final shoe to drop for a recession. So Chattadonia, keep these two things in watch. Watch the Philly Fed. Watch now with non-farms if good news becomes good or bad becomes bad, because jobs will be the final thing. And then I'll put it as the cherry on top. Just don't forget about the 2 and 10 year curve. This is the yield curve being inverted. It is uninverted a lot since the SVB situation, but it is still inverted. It's just recovered half of that inversion. But this is another thing. And by the time this uninverts and you see that go from negative to positive, watch all these other factors and watch how people are talking about the recession, okay? So we'll see, but that's all I wanted to share with you. But now, if you didn't watch this video at the beginning of the week, we went over all of the biotechs and we bought a good amount. I bought like half of that list there because some didn't really meet the criteria. Well, next week we're going to get a lot more alongside all the big tech earnings, but here is the performance so far. So this is just a screenshot since I'm recording this in person, but you can see all the plays that we have. We have Ascend, that's in the top left there. I don't know what's in the top right, but there's MCRB, then we have DSNKY, and then you have IONS. So these are all data in the next 2 weeks now of biotechs, and since we bought them on the pre-PDUFA run-up, I'm up on Ascend, I am up on DSNKY, and I'm up on MCRB, and then I'm down on IONS. So you'll even notice too, I kept most of them 100 shares, but the one Ascend was more expensive, so I did 50 shares, and then McRib, I fat-fingered with 500. So if we bought equal amounts, I think the performance would be about break even, but this is where we're at so far with those. I'm still riding them. Again, I didn't buy EBS, and I might get into that, but for now, Get ready for all of the data next week. Gonna be writing those out. I have a couple of earnings plays and just gonna go back and forth. But really, next week, I'm gonna have everything for you. We're gonna go over. It's gonna be all about big tech earnings and see if we get out this range. So Chad, keep it simple. Woosah. And get ready though, and I hope you're patient for the recession. Okay, I don't know why I'm bringing out money with this, but for real, we've had this talk so many times, and it's clear there's stuff going on with the economy. I hope you realize it, but the thing is, it doesn't have to happen immediately. And one thing we've learned already, they want to buy time. Who is they? It's the Fed. It's the big banks. It's big money. They want to have more time. So if you could get an extra 6 months while keeping everything stable, that's more money, more profits, more times to maneuver and come up with more ideas. I mean, the highlight I've been saying is that it's been 6 months since October, the very worst, and we're generally at the same price right now. So they bought 6 months of time already just with the no landing, soft landing, this, that, bank, this, no banks. So just think about that. That's all buying time, and really make sure you give yourself time, and it is all about reacting at the same moment. But if you're kind of really expecting something to collapse immediately and making crazy plays on that, and you're like, I need a big immediate collapse right away, or you're like, oh, it's going to be a generational rally, I got to buy everything because after this next month, once it rips from here, it's never coming back. Those two people are exactly the same. We talked about this today. It's the same logic where they need an immediate move up or down. And what I tell you, this whole situation, again, it's been maybe 5-6 months since I've even brought up the Philly Fed. It's been almost 12 months since the yield curve. Point is, play the time. It's going to be pretty choppy in the meantime till we get certainty. Once we get that certainty about recession, no recession, the scope of it, then we go from there, Chad. So hopefully you enjoyed it. I'll see you in the morning, and that's it. I'm not going to be awkward. I'm already wearing an awkward enough outfit. Like, what is this, bro? Like, I like it. My mom got it for me. I'm very sentimental about it. It's very comfy. I like it. Make me look swole, though, a little bit. All right, I'm out. I made it awkward.